Ladies and gentlemen, good day and welcome to Niyogin Fintech Limited's Q2 and H1 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sonia Keswani from Ernst & Young IR Practice. Thank you, and over to you, Ms. Keswani.
Thank you, Michelle. Good morning, everyone. On behalf of Niyogin Fintech Limited, I welcome all of you to the company's Q2 and H1 FY24 earnings conference call. You would have already received the quarter's results and investor presentation. It is also available in our filings with the exchange. To discuss the company's business performance, we have with us today Mr. Tashwinder Singh, the Chief Executive Officer and Managing Director, Mr. Abhishek Thakkar, the Chief Financial Officer, and Ms. Trivenika Avasthi, the Investor Relations Officer of Niyogin Fintech. Before we proceed with the call, a disclaimer. Please do note that anything said on this call during the course of the interaction and in our collateral, which reflects the outlook towards the future or which should be construed as a certain forward-looking statement, must be viewed in conjunction with the risks the company faces and may not be updated from time to time. More details are provided at the end of the investor presentation and other filings that can be found on our website www.niyogin.com. Should you have any queries or need any further information at the end of this call, you can reach out to us at the email addresses mentioned in the company collateral. With that, I would now like to hand over the call to Mr. Tashwinder Singh. Thank you, and over to you, sir.
Thank you, Sonia. Let me start by thanking all of you for joining us this morning. I welcome you to Niyogin Fintech's earnings calls for Q2 and H1 FY24 results. Like always, I would like to start by giving a little brief about our company. Niyogin Fintech operates on a tech-centric platform-based model wherein we deliver banking as a service or the BaaS platform and credit to rural and urban India through a partnership-led strategy. Our partnership-led strategy allows us to tie up with local enterprise partners that have a large and deeply penetrated distribution infrastructure. We utilize this infrastructure for cost-effective reach to our customers, which are largely the MSMEs. Once we onboard a partner, the BaaS platform is employed by them in their customer-facing touchpoints that enables these touchpoints to provide banking, payment, and financial services to their local customers. The partner-led strategy helps the company reach out to a large number of MSMEs and SMEs through every partner it onboards. The revenue model is primarily transaction-led, where we earn a fee or commission on every transaction that is routed through the platform. Being an NBFC, Niyogin has been serving MSMEs by providing credit as well. Niyogin's distribution platform, NeoBlue, enables lead generations and offers credit along with other financial services to MSMEs digitally. The company has employed various lending models and earns either an interest income or a fee for the loan lead generation. Let's get into the quarter that's gone by. We are pleased to share our operating metrics continue to report a strong growth in this quarter as well. Other than that, one of our key accomplishments has been our long-term loan rating, getting assigned a BBB- stable rating by CRISIL, which is an investment grade. While our lending business is undergoing a gradual scale-up, getting rated acts as a boost to expanding the loan book that grew by 15% Q-on-Q and currently stands at rupees 135 crores. As lending is one of our focus areas for the year, we have laid down a detailed path to scale it up effectively. We are adopting a differentiated approach towards building the distribution channel, managing risk, and achieving cost efficiencies using technology. We identified these as the 3 pillars for this strategy. To build our first pillar, distribution channel, we are scaling up our business with existing partners alongside new partners on our NeoBlue platform. These partners include chartered accountants and fintechs that have large distribution infrastructure and therefore create leads on the platform and also financial institutions to enable co-lending. On the distribution side, we have more than 30 financial institution partners. This is a fee business and an ROA business, which is ROA accretive, as we do not take any share of the credit risk, purely a distribution business. Our second pillar, which is managing risk, revolves around using automated models for risk assessment. The aim is to build predictive risk models by benefiting from high volume of cases being generated through fintech alliances and the NeoBlue platform. In our third pillar, achieve technology-enabled cost efficiency, we are focused on building strong loan origination, loan management reporting systems. We are further enabling multi-product, multi-partner integration to avoid any additional costs and therefore demonstrate operating leverage as this business scales. We are confident in our ability to capitalize on the MSME opportunity and remain driven by unit economics. I'm also happy to share that we appointed Mr. Hitesh Jain as the new Chief Risk Officer. He will play a crucial role in fortifying this business. Going forward, you will see the lending book contribute significantly to our profitability as it starts achieving scale and operating leverage on the back of the partnerships we are forging. As we know, we are also building the bank service or BaaS business, which has been doing well consistently. Our revenue X of device to sales stood at 47 crores, up 5% Q on Q. This has been a result of the GTV, which is the gross transaction value, that grew 17% Q on Q, crossing the rupees 10,000 crore mark for us for the very first time, and standing at over rupees 11,500 crores in Q2 FY24. We also processed more than 42 million transactions, which is higher than what we did in the full year of FY23. In the coming quarters, we expect our GTV trend to further strengthen as we expand our footprint and explore cross-selling opportunities within the existing partner network. Our BaaS network expanded by 21% YOY to 845 partners. By leveraging the strength of these relationships, we aim to remain a key player in the industry. The quarter also came with this unique set of challenges. The UPI business, which is a high-margin business and has scaled materially for us as it contributed over 500 crores in GTV in September alone, saw some headwinds in terms of regulatory requirements. We pride ourselves on being compliant with all extant regulations. As the industry is evolving and the regulations around these businesses are becoming more stringent, we are seeing the impact of some of these on the margins we make. We are working with banks to find an efficient way to resolve and solve for higher margins. We believe the UPI net take rate will remain relatively subdued for the next 2 quarters as we find solutions. In the business continues to scale and we continue to add new incremental clients. We remain focused on growth, both organic and inorganic. The prevailing market conditions have opened up opportunities for us to acquire some interesting bolt-on businesses. We are engaging in multiple conversations with complementary businesses. The attractive valuations, business synergies, market adjacencies, and tech competencies enablers are the parameters driving our conversations. I would now like to hand over to Abhishek to take us through the financials and other details of Q2 FY24 and H1 FY24. Post that, we can open this up for questions and we can address. Thank you, and over to you, Abhishek.
Am I audible? Well, thank you, Dash.
Yes, you are.
Thank you, Dash. Good morning, everyone. So before I take you through financials, let me give you some update about our operational metrics. Our BaaS partners stood at 845 as on 30th September 2023, as we added close to 50 new partners during the quarter. Gross transaction value, that is GTV, including the payouts, stood at approximately rupees 11,563 crores in Q2 of FY24, up 17% Q on Q and 293% year on year. Our transaction volume stood at 42 million, which resulted in an average transaction size of rupees 2,753 in Q2 of FY24 compared to rupees 2,943 in Q1 of FY24. Contraction in the average transaction size was due to the release of DBT during the quarter and is in line with the industry trends. Gross take rates dropped sequentially from 36 bps to 32 bps in Q2 of FY24, while net take declined from 9 bps to 5 bps. This was due to change in regulations which led to change in UPI processing partner mid-quarter. As stated by Tash, the new commercials have adversely impacted UPI product economics, driving net product take rate from 9 bps to 5 bps. Also, the reported take rates do not account for the revenue booked against UPI-related services rendered for the month of September, as there has been a delay in revenue realization, and we expect this to be recognized in Q3 of FY24. Our finance professional network increased by 9% year-on-year and stood at 5,478 as in 30th September 2023. We further processed 19,223 loans through our network in Q2 FY24 and reported an increase of 347% year-on-year and 51% quarter-on-quarter. Moving on to the consolidated financials for the quarter, our revenue excluding device sales stood at rupees 47 crores, up 91% year-on-year and 5% Q-on-Q. Consolidated revenue for the quarter was a little over rupees 47 crores, up 79% year-on-year and 4% Q-o-Q. So basically, our Device sales business, is completely used, and we are gearing up for the other businesses. The revenue remained flattish sequentially despite QoQ growth in GTV, primarily due to contraction in take rates, as explained earlier. The adjusted EBITDA ex ESOP loss gap widened from rupees 4.3 crores in Q1 FY24 to rupees 8.2 crores in Q2 FY24 due to three reasons. One, the revised commercials related to UPI that impacted take rates. Two, incremental provisioning of rupees 75 lakhs taken towards lending. And third, provisioning for unrealized receivables of rupees 3 crores taken in ISW. This provision was on account of devices that were returned by the customers. We plan to redeploy these devices with minimal incremental cost in the upcoming quarters. ESOP charges for the current quarter was over rupees 1 crore versus rupees 90 lakh in the previous quarter. The non-GAAP PBT stood at negative rupees 10 crores in Q2 of this year, as against the negative non-GAAP PBT of rupees 6 crores in the previous quarter. Our cash and cash equivalent, consolidated cash and cash equivalent, stood at rupees 115 crores as on September 30th, 2023. So with that, we can now open the floor for questions. I would like to wish you and everyone at your family a very happy Diwali and a prosperous new year. Thank you so much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star followed by one to ask questions. The first question is from the line of Yash Modi from Ashika Group. Please go ahead.
Hey, good morning, Dash. Season greeting to you and the
Hey, hi.
My first question pertains to this credit rating. So could you just triple B minus? Could you, and right now we stand at a loan book of 135 crores. Could you just reiterate the loan book guidance for FY25 for us, FY24 and FY25? How are we looking at things?
So we have not given a formal guidance for FY24 or 25 on the loan book size. We've not given that out. But my expectation is that we will get to anywhere between 200 to 215 crores for FY24, right? And FY25 we will try and get closer to about 400 to 450 crores. And depending on how these partnerships scale up, may even be a little higher than that in FY25.
Got it. Second question is on this net take rate coming down from say 9 bips to 5 bips.
Yeah.
So we're saying that the UPI portion, say it's written 500 crores in September. So I'm assuming, best case I'll assume 1500 crores of UPI in the quarter, which is roughly around say 12-13% of the total GTV. So that coming down from 10 bips to 4 bips, taking down the entire book from 9 bips to 5 bips. What am I missing here mathematically? What am I missing here? Something else has also come down, or is it only the UPI portion?
No, I think firstly let me explain the UPI thing, and I want to explain this clearly to everyone. Firstly, the September UPI revenues have not been booked. So there is a 4 crore revenue that's not been booked, which will get booked in October, primarily because of the change regulations in UPI. We had to change our nodal account, bank account from one bank to the other, right? Because of various reasons. And the revised economics with the new worse off than the first bank. And we need to go back to the first bank as we solve the regulatory requirement that the bank has. So that is point number one. So this is a temporary phenomena that has happened where these revenues have come down. As we move back, our economics change again, and we will be back to the higher economics that we used to have, number one. So firstly, the GTV has been counted in, but the revenue of the September GTV is not brought into the numbers. So that's what is missing in the numbers right now. You add that, the GTV anyway moves up by a paisa or so it goes to about 6 and 6.5. On that basis. That explains first thing. And secondly, there will always be a 1-2 paisa movement of GTV up and down because of the way the business is structured. As you know, the cash out GTV is always on the lower side, right? Because that's just a cash out product. And if the cash out is high on a certain quarter, then the GTV for that quarter will move down. It doesn't change the business in any way. I think what is important for us is while we are solving all these issues, the business, underlying fundamentals of the business continue to remain strong, with customers accepting our tech, our solution, and scaling up, on our GTV and on our business. So both things are important to us. We need to keep scaling, get new partners in, get more volume through it, but then we also need to make sure that we are processing that volume with the most efficient way of performing. And in UPI, this has been a specific issue that has happened, which, previous quarter we were at 9 paisa, largely driven by the full economics that we were making of UPI. So I'm still optimistic that we will solve the problem, and therefore you will get that economics going back around that level in the next couple of quarters.
Got it. And in terms of partner addition, this quarter has seen excellent partner addition growth after long time QOQ. I'm seeing around 50 partners getting added, roughly around 6-7% of the total partner base we had. So any big wins during the quarter which you would like to highlight?
No, I think there are a few wins. But
last quarter you had said that we're looking to go more deep into the partners that we already have. So it's a pleasant surprise that the partner count has again started to increase.
See, what's happening is, the proposition, the solutioning that we have is now getting well accepted in the market. So while we have a small sales team that is out there getting partners, we are also getting a lot of inbounds. And therefore the increased partners are all, some of it are coming because of our own sales, some are coming because of word of mouth, because people in the market have started accepting our solution as a good solution for what we are providing as a BaaS service, number one. Number two, we are getting deeper, and the whole idea is that for the existing large enterprise partners, we should be able to offer supplemental products. One of the data points that I track is also how many products we are doing with every partner, right? So that also is an interesting way to think about cross-sell and getting more for the same bang buck, more bang for the buck is the way we are thinking about it. We have a couple of marquee partners who've been acquired this quarter, but they haven't gone live, and we do not have permission from them to share their name yet till we go live. So those names I will circulate in the next quarter or maybe when we go live with them. But there are some interesting partners that have come across on our line. With India Post, for example, we have expanded 2 new products, right? And there is work happening on incremental products with them as well. So slowly and steadily, I think the real operating leverage that should kick in business will start kicking in the next couple of quarters. That's when the game will start becoming a lot more interesting.
Got it. Last quarter, we had taken some costs related to the prepaid card that we intend to launch during this quarter. Any update on the prepaid card portion of the business?
So the prepaid card proposition is completely done in the sense that our build is done, right? What we've done is we have contracted with 4 or 5 parties where they will be issuing these prepaid cards. Regulation requires that prepaid cards can be issued by people who have PPI license. So we don't need it, but the partners who have the license can only issue the prepaid cards. So the conversations are going on. There is integration required at various ends. So the cards have not been launched yet, but we are hopeful this quarter, towards the end of this quarter, we will have our first cards out in the market as well. There has been a little delay in that. My expectation was that we would be live by now. We are live on our platform, but the dependence on customers deciding when they want to launch their card program will decide when our revenue starts flowing in.
So that probably explains the flat GTV that we see for October, probably for 4,000 crores. Is that the correct assessment?
That's right.
All right. And
October is the flattish, but sorry. Please go ahead.
October is flattish, but
no. I think you're right. Your observation is correct. The impact of the cards business hasn't taken off yet, and therefore there is no GTV of that in this October number. Once that comes in, we are obviously very optimistic that will scale the GTV up materially. And so the team is working on getting that off the ground in the sense with the customers.
Got it. And my last question would be this receivables that the device, Abhishek explained the devices that have come back. So last quarter we had taken a hit of around provisioning of around 4.5 crores. Total first half we've taken a provision of 8 crores. So I understand that these devices will again go out in the market, but any explanation, because 8 crore for our company seems a little on the higher side.
No, it is on the higher side. There is no, let's call a spade, right? It is on the higher side, number one. Last quarter when we had taken the provisioning, the receivable related provisioning was only about 1.2 crores. The balance were all old items in terms of reconciliation issues with banks, etc., as I had explained, right? Those were all one-time issues. What has happened this quarter is that about 2.4 to 2.5 crores worth of devices that we had sold, between the last 6 to 8, because we don't sell too many devices now, right? That's not a line of our business that we pursue anymore, right? We only do it when there is a specific contract for one of the enterprise partners. So it's a funny situation because we've actually received a large contract for devices from one of our large enterprise partners. And one of the strategies we took was that instead of going and buying new devices, if we have some devices that are stuck with our old partners, which they are not able to sort of utilize or sell, maybe we should just get them to give it back to us so we can redeploy these devices to the part, because we have the orders for these devices. So what we did was we actually got the devices, we spoke to the partners, we got the old devices returned to us, right? But what that also meant is, standpoint, right, till the time the new devices are actually delivered to the new enterprise partner who has asked us for these devices, right, we will not be able to book that revenue. And from a provisioning standpoint, the auditor felt that the old receivable was running high, and therefore a provision has been taken. This will get reversed out as these devices go away. We have contracts whereby these devices have to be delivered to a new party. So I think our hope is that this device-related matter will get resolved in this quarter itself. That is the plan, and that is the hope that we have. So this is a little bit of a self-inflicted wound, if you may, wherein we've actually got these guys to give us the devices back, right? And the devices are sitting with us, but because these are 6, 7, 8-month-old devices, right? The auditor was very clear that we should provide for this, because if the sale doesn't happen, then what will happen? So we've provided for that, and when the sale happens, this will come back.
Got it. Just the last question, if I may. On this, the lending institutions that we do distribution for, so say out of this 47 crores of revenue this quarter, if I just break it down, so 12,000 GTV at 32 bips would be 37 crores. 7-8 crores would be interest income because of our 135 crore book. So the balance 2-3 crores would be this distribution income that we are doing for this lending these institutions. Is that the correct assessment of the revenue breakup?
Yeah. We are doing about 30-40 lakhs a month broadly gross revenue coming out from the distribution side, which is actually negligible because, as you know, we just launched the Niyogin platform, right? My estimation is before the end of the year, we should be sitting at 1 crore plus is what I think we should be hoping for per month, right? And therefore that can lead to, and this is all, as you know, fee income, right? There is no risk here. There is no risk that we are taking out here. So the Niyogin platform is stabilizing, and we've got more and more partners now logging onto the Niyogin platform and putting transactions through that. The idea is to create a complete digital journey where a customer can come in through their partner, and on the flip side have more than these 20 lenders who can actually take up the loan and just disburse the loan, and we make our commission from that. So it's an interesting proposition. The tech spend has been done. The sales team that we've created is all done. I think from nothing, we have already started creating 30-35 lakhs of revenue every month, which will get you to your number of 2-3 crores, give or take, right, for the year.
Okay.
But I think the actual number for this year will be much higher than that. And for next year, I'm expecting this number to be materially higher from the distribution business.
So the right way to look at it is this: in the standalone, the BSE update that you gave, the standalone portion of the business, the fee income that is there after the interest income, moti say 50-60% of that would be this distribution business. Because that
not 100%, because even on the lending side we take fees.
Correct.
So correct. It won't be 100%, but that's a fair way to think about it. Yeah.
Got it. Thank you. All the best. I'll get back into the queue for more questions. Thank you.
Thank you.
Thank you. Participants who wishes to ask questions may please press star followed by 1. We'll take the next question from the line of Pranav Gupta from Aionios Alpha Investment Managers. Please go ahead.
Hi, good morning, team. Just a couple of questions. A lot of the questions have already been answered. But, Tash, if you can just dive into the details of what the regulation change was on UPI and how it has impacted. If I understand it correctly, you mentioned that it's impacted our partner bank in terms of compliance, and hence we had to switch mid-quarter to another bank. So if you can just delve into the details and explain to us what's actually happened there.
Yeah. So I'll explain that. See, what has happened is that RBI came out with a circular, which basically looks at anyone who's doing a payment business, right, and payment acquisition business, right? What is our UPI business? We are actually powering other platforms to be able to accept UPI as a payment. So if you have a website and you want to suddenly start accepting UPI payments, I can power you for doing that, right? That's the tech that I'm providing you. So I'm on the acquisition side largely. I'm also on the issue side, but more on the acquisition side. So RBI came up with a circular that is saying that the people who are operating in this space should be having a PAPG license, which is a payment gateway license, right? Now, they've not issued any payment gateway license. All licenses are stuck for the last 2 years. They've not issued. And therefore, it was just a guidance circular that they gave. Our nodal bank that was doing our settlements told us that you need to apply for the PAPG license. We don't need to get the license. We need to apply for the PAPG license, right? So we need to be in queue for that, right? And their view was that for them, they didn't want to take RBI questioning them that why are you doing settlements for us, right? Whereas it's not a clear regulation saying that you have to, because the PAPG licenses have not been issued. Over the last 2 years, people have applied, and we are hopeful that RBI will start issuing these licenses in the course of this next quarter, right? So other people are still doing this business. We are doing this business also, and other banks were willing to accept doing our this thing. So we had to move our nodal account from this bank to another bank. Obviously, the economics changed as we moved away because we were going with one hand tied at the back for doing the new, settlement. Now, we need to apply for the license. We had applied 2 years ago for this license, and, RBI had asked us to come back with the application with clarification. That's why I said over the next couple of quarters, we will get this sorted, whereby we will again be back to the relationship with the old bank is very, very strong. We still use them for doing all the settlements for all the other products. Except for this product, they've asked us that we need to get the application done. So it's an interim, phase that we've done where we are working with the second bank. I'm sorry, I can't share names of the banks, but we are doing that, and therefore the economics have taken a little bit of a hit. But like I said, it's a temporary economic hit because we are doing this with another bank, and we plan to go back to the old bank once we have sorted out this issue of application, etc.
Right. Just as a continuation to this question, are we in the process of applying for the payment aggregator license, or have we already applied and waiting for the RBI to sort of respond to that?
So we are in the process. We are in the process. We have not applied. We are in the process, and there are some very interesting ways to get this sorted. So you'll have to just give us a little more time for us to come back to you with how we are solving this while keeping our economics, good.
Sure. I appreciate that. The second question was on, just a follow-up on to the device returning part, the provision that we made on the book. Just want to understand how the accounting works because if you had, and you can correct me if I'm wrong, if and when you had supplied the devices to your erstwhile partners or partners who were using these devices, I'm assuming that you would have sort of charged all the partners upfront. Now that those devices have been returned because of whatever reasons, why have we had to reverse this revenue that we recognized earlier? Or is it a case of recognizing this revenue as and when they sort of scale up the transactions?
So the revenue had already been recognized when the devices were sold, right? 6-9 months ago, whenever they were sold, right? So Abhishek, maybe you can answer that question. I can give more clarity, but from an accounting standpoint, if you want to clarify, I can come and give some.
Sure. Yeah. So when we sold the devices, we had booked this revenue, right? Now, generally, what happens is when the devices are returned, generally, it is either built up in inventory or, you immediately sell it. In our particular case, there was little time there because the devices were returned by September, which is the accounting cutoff. And now, we are really in this particular quarter. And since these devices were like 7 to 8 months old, the alter was like, since you have, as of 30th September, you have received the devices back and you have not sold by September, you please reverse the revenue for now, since it's the material amount of about 2.4 crores. And whenever you sell it again, you book the revenue again. So that is why, we have reversed this particular part to the devices.
Yeah. Have you refunded this amount to the customers from where you received the devices?
Sorry?
Have you refunded this amount to customers from where you received these devices back?
No, they were in the receivables only. They were not. They did not pay the amount for this particular.
The point was it was an entry sitting in the receivables. The devices were sold and there was a receivable outstanding.
Sure.
So there was no question of any refund, right?
Right. No, I just need more clarity on this. I'll take it offline for the better, for better understanding. Just one last question.
Yeah.
Sorry, I missed I believe you gave some numbers on how the loan book will scale up over the next couple of years.
Yeah.
I missed that because your voice sort of cracked. If you could just repeat that will be very helpful.
Sorry. I'll tell you. See, we are not aggressively scaling up to suddenly go from 135 to 1,000 crores in a year. That's not the plan. Plan is to be thoughtful in the way we scale up this business. We are at about 135 crores end of September. We think this number can easily go to 200 plus, 215 crores in that ballpark by the end of this financial year. And we can pretty much double that book in the next financial year, right? And reason we went, even though our book size is small, we still went ahead and got the rating done was primarily to make sure that we are able to activate this plan of scaling up like this. The leverage that we have is negligible, right? Our net worth is in the ballpark of 320 odd crores, which will go up to about 360, 380 odd crores, right? And even if you take 1x debt equity, we'll still be below that in terms of, to meet our requirements. So that's the plan. The plan is to get to a number which is, maybe shy of 500, between 400 to 500 for FY25, and for FY24 will be anywhere between 200 in that ballpark. Hello?
Right. Sorry, just lastly on the UPI bit again, you mentioned 4 crores is the revenue that we didn't book in September because of the change in partner and the middle account.
Mr. Gupta, I'm sorry to interrupt. Your voice is muffled, sir.
Is it better now?
Okay, I can understand what he's saying. Yeah, no, continue. I can understand what you're saying. I mean, it's coming through. So you mentioned UPI September revenue. You had a question.
Yeah, it's 4 crores is what you mentioned, right? That's not been recognized this quarter.
Yes.
And that's the gross revenue.
That's right.
Okay. Perfect, Ash. Thank you so much for patiently answering the questions, and good luck for the future quarters.
No worries, Pranav. Thank you for joining. Yeah, I appreciate your joining morning call to this. Thank you.
Thank you. The next question is from the line of Vishrut Gupta from 77 Capital. Please go ahead.
Hi, Tash and team. Wishing you the season greetings. So, initially to start off, I'm curious as to the existing customers who are fairly mature. For example, like an India Post and an NSDL and a Bharat Financial. What percentage of the sort of existing merchant distribution are we already deployed in, and what degree of penetration is still left with those existing customers?
So I think we should say firstly, hi, thank you for joining. I think it's an interesting question because there are different partners who are scaling up at different levels, right? So take India Post, for example. India Post, we are probably there in about 10 to 15,000 retail outlets of theirs, but they want to build 2 lakh outlets, which are their BC agents they are building. So the point is, at some level, we are expanding in their current footprint, and they are expanding their footprint, and all incremental footprint automatically is coming to us. So as they put on a new BC, that business comes to us 100%. For the existing platform, obviously, it's a little slower because they need to get the existing teams on the ground, trained, etc. The new guys are all coming to us. So we think significant level of growth will happen. Already, our enterprise, the GTV contribution to our enterprise is more than 50% now, right? So the enterprise businesses are scaling up much faster. In CSC's case, again, one needs to look at product by product, right? Because we started life with them with micro ATM, right? And therefore the micro ATM penetration is the highest. All the other products, DMT, AEPS, every product has gone live at various points. So there is significant opportunity for us to continue to scale up with these guys still, right? And we still see growth quarter on quarter with each of these partners. So I can't give you a percentage number of what the percentage penetration is, but I think it is safe to assume that we can easily double whatever we are doing just with these existing partners.
Understood. So just a follow-on question on that. So say with each of these merchants which we've acquired via these partners, from what I understand, with the one micro ATM device we currently provide with them and the software on top of that, it does not have the checkout facility that, say, a Soundbox or one of those placards with the QR code would have. Just to clarify.
Right.
So is there...
No, so there are options.
Sorry, go ahead.
Sorry, go ahead. Go ahead.
No, please finish your point. I'll come on.
So you know, for a QR code, again, you go back to the whole payment gateway issue, right? For us to be issuing QR codes, we need to have a payment gateway or a payment gateway partner who can issue the QR codes. And we don't need to have the license. We can just tie up with a partner, number one. Number two, the sound boxes is something that we have received now requirements from one major bank where they want us to include the sound boxes in the micro ATM or the product that we have. So we are getting that sorted as well. But so far, the deployment that you are talking has been largely without the sound boxes. That's correct. But in the next quarter, you will see that there will be some deployment with sound boxes.
So just a follow-up question on that, does any incremental software build need to go on, or can the existing software just be repurposed for that? And going ahead...
No, the existing software is getting repurposed. We've also done the UATs. It's all already done, right? So that it is just the existing software that's got repurposed. There is no incremental spend that we need to do. It's the same team that has just repurposed our software to include the soundbox also. But that's largely for the POS machines.
Understood. So do you view this as a way where the incremental revenue per merchant can be increased by essentially upselling this to your existing merchant base, or have I got that correctly, where they have two separate devices basically, one for the withdrawal, the transaction business? And
So RBI requires the micro ATM devices, AEPS devices to be different from the POS devices. So there is no integration of these devices into one device, right? The soundbox is largely used on the POS devices where you are accepting payments, right? As you would have seen when you go to these small merchants, you know, you do a UPI payment and suddenly there's a loud voice that says 300 rupees received or whatever the number is, right? In the micro ATM proposition, it is just an authentication device which is being authenticated to give you cash. It's a withdrawal product. So there is no need for a soundbox in a withdrawal product, but in the accepting product, there is a need for a soundbox. So the POS deployment is very different from the micro ATM deployment. So our large deployment has been really the micro ATM deployment, not the POS deployment, right? So I don't think you can assume that there will be a significant build out on revenues because we'll sell this product to every merchant, right? I would not go up that path.
Understood. And just wanted to go into another product, which is the debit card product. So just wanted to understand that where all along the sort of debit card product stack are we catering, or is the solution covering everything? So from what I'm understanding, there's like a switch layer, there's an issuance layer, there's also the card management system. So if you could just, you know, go into where all, or if you could...
we have the card management system, we have the switching capability, and the card issuance per se, which is the physical issuance, is all outsourced, right? We don't need to build that in-house. That's all outsourced, right? So, but the switching capability and the card management system is all in-house. That's the solution that we are providing to our partners.
Understood. And just wanted to clarify another point you had mentioned earlier, I think to Yash's question, that you had a certain number of partners who you'd already onboarded and are yet to go live with, or are they in the integration phase, or are they yet to be like contractually onboarded?
No. So contractually, we've done a few contracts, right? But they have to go live when they want to go live, right? So we are ready with the tech solution. They need to do, there is some level of tech. Every partner is in a different stage of evolution, right? So I can't put one sweeping brush. With some partners, I'm hoping we'll go live in the month of, early December with one partner. With the others, we are doing tech integration because they need a full tech integration of our platform with their platform. So that will take a bit of time, but we are on the job. Nobody gets into tech integration without signing contractual agreements, right? We would not spend our time and effort if the contractual agreements are not signed. So this product will go live. It's a matter of time. We are very optimistic because when we look at the broader part, I mean, think about the whole card infrastructure in India, right? There are about 90 million credit cards. There are about 900 million debit cards, right? So each of those debit cards can effectively be converted into a prepaid card. So the market opportunity is so huge, right? We just need to get the ball rolling, and I would have liked this to have already been done, but we have to work with the pace of our partners, right? We've done everything that we had to do in terms of building out the infrastructure. Now we have to wait for our partners to sort of get the card issuance done. I think we will issue some 50,000 cards for one partner. That is the plan soon enough. But that again is just tip of the iceberg, really, not really the real opportunity. So I would say we should just keep watching out for this space. Over the next couple of quarters, you will have some news around this, on how this is playing out.
Understood. And just a final question around this. What is the revenue model again for the debit card business? Like, is there fixed plus variable, or how does that work?
So it is a fixed plus variable. There is a fixed fee that we would give, right? There's tech integration cost. There is per card issued, there will be a cost, right? Because we have a cost also, right? And then there is on the MDR, there is a sharing that happens. And then the prepaid wallet, whatever money is lying in the wallet, what we can make in terms of float revenue. Again, this needs to be negotiated. There are two discussions happening with two banks. So there are multiple opportunities for revenue generation there. And I think that's why we feel pretty excited about this product, because this product will have economics which are hopefully better than the rest of it. Because, micro ATM, AEPS, these products have become standardized products, right? And there is no way you can scale up your net revenue or net take rate on these products, right? You can scale volume, absolutely. But the net take rate, whatever it is between 6, 7, 8 basis points, that's what it's going to be. Card business, I think the take rate will be higher. So it will help the UPI business, the card business, some of the new things we are doing, the account opening. These are all businesses which have higher margins, right? As these margins come in, as these businesses, then you will start seeing the take rates move up. Notwithstanding the blips that we keep having, that we had in this quarter on the take rate, driven by a very specific issue. Long term, if I look at the business, I think the fundamentals are quite strong, right? Which is why we have incremental customers coming in, we have incremental GTV happening, and we have the scale increasing, right? And as these new products get deployed, I think we will see the take rate enhancement also happening.
Understood. And sorry, just one final question was around, one product that I've seen, other similar companies in the payment software company upsell is online dispute resolution and something on this, entire dispute resolution piece. So I'm curious, do we already have a solution or some sort of tool that we give around that, given that it's a big problem both in AEPS and I'm guessing in card payments? So just curious as to how we tackle that problem.
Yeah. So for the consumer, there is an online method to put out a complaint, right? There is a bot to help a consumer also think through, but the consumer is not the person who's working. We don't have a consumer app here, right? In our business, our app is used by the retailer. So as far as we are concerned, our customer eventually becomes the retailer. The consumer is the customer of the retailer. But there is a helpline, there is a online portal where the consumer can also log in their complaint, which is required. I think it's required by law. I'm not sure, but we have it. But like I said, our customer is really the consumer, really the customer, really the retailer. And if the customer has a problem, the customer has to first reach out to the bank where he's banking with, right? Because we are serving the customer on behalf of the bank. So if you are an Axis Bank customer, you go withdraw money from a retailer, and if assuming you feel that there is something being wrong to you, your first port of call has to be your bank, because that's the entity. You don't know me. Because you don't know me, because I am a TSP to the bank and I am providing the app to the consumer, to the retailer, right? So that's how the customer service angle works. We have a customer service, entire infrastructure for helping the retailer in case he has a problem in executing the transaction. The individual consumer who has a problem, that problem actually goes to the bank, and then it can circle back from the bank to us, asking us for the data, etc. So that's how it works right now. I hope that answers the question.
Yeah, understood. And just for clarification, I was referring to more of selling that product to the bank itself, where I've noticed this chargeback
Yeah,
management, chargeback automation, and just for the dispute management itself, where a lot of these banks traditionally use these large risk management teams and risk officers. It tends to be siloed in that department. That using these sort of tools, and payments companies are trying to effectively upsell this because they can increase the contract value per bank.
Yeah, I think we can explore it. Not done yet, yeah, quite honestly. But it's a good thought. Why don't we take it offline? I want some more details on this. Let me take it offline with you.
Perfect. Thank you.
Thank you. Participants who wishes to ask questions may please press star followed by 1. Now, we'll take the next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Hello.
Yeah, hi.
Yeah, good morning and thanks for the opportunity. So basically, I had a question regarding the ISW business. So if I look at the ISW numbers over the last, let's say, 8 to 10 quarters, the revenue net of fees and commission expense has been a bit volatile, right? And so basically what I've done is minus the fees and commission expense from the fees and commission income just to get at a margin number. So, this number has been a bit volatile in the last, let's say, 8 to 10 quarters, moving from as low as 3 to 4% to, I think last quarter it was around 20 odd percent. So, just wanted to know what could be the stable margins we could get from the ISW business going forward. And, if the volatility continues, how will we arrive at the guided 8 to 10% EBITDA margins?
So I think the ISW business should be operating, again, like I said, the business starts becoming interesting, as the revenue scale up and operating leverage kicks in, right? Today, if you look at the net take rate, what is the net take rate? Net take rate is in the ballpark of anywhere between 6 to 8 basis points, right? Notwithstanding the 5 paisa that we shown on the slide out here. Once the 4,000 rupee gets counted in, it'll come to closer to 6, right? So 6 to 8 basis points is where the net take rate will stay, right? And that's really the number that matters to us because that's the money we take home, right? And it's used to pay for our expenses, right? We think at that take rate at about 6 to 8, basis points, our margins, our EBITDA margins should be anywhere between 18 to 20% on a steady state basis once the business sort of stabilizes. So, but it will take us a couple of quarters to get there. It is not going to happen in one quarter. The volatility stays because we are building businesses, we are adding products, we are adding new customers, we are changing the mix from retail to enterprise. So there are a bunch of moving parts that are happening, and every quarter we are seeing changes happening on this count, right? So some level of volatility has stayed. I think we will still need a couple of quarters for this to start stabilizing and then giving you numbers that you can then try and easily model, right? I don't know if Veronica, there's anything else you want to add to this? She's our investor relations and she sort of does the analysis of the ISW numbers deeply.
Mr. Kulkarni?
Veronica, you're
Yeah, that answers my question. Thank you very much and wish you a very happy Diwali to all. Thank you.
Thank you.
Thank you.
Participants, you may please press star.
If there are no more questions, then can we wrap up?
Yes, sir, if you want to. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah. Thank you, guys. Thank you all for joining the call. Wish you all a very happy Diwali, right? Our business continues to scale. I think we remain excited about the opportunity. I think the one thing that we haven't discussed is the potential M&A opportunities that are coming along us. I'm hoping that in the course of the next quarter or so, we'll be able to talk to you about some interesting bolt-on acquisitions that we may land up doing. So that is an interesting thing that we are spending some time on, but these are binary outcomes. So, but I think the market opportunity is presenting some interesting opportunity. Market is presenting some interesting opportunities for us. So I would urge all of you to stay tuned onto our company and I look forward to talking to you again next quarter. Thank you all.
Thank you very much, sir. Ladies and gentlemen, on behalf of Niyogin Fintech Limited, that concludes this conference. We thank you for joining us, and you may